The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague, the man who'll hopefully never have a week like Richard White's. It's Anthony McDonald. How are you, Anthony?
Yes, James, the higher they fly, the harder they fall.
Indeed, indeed. Well, this week we dive into the drama surrounding two of Australia's billionaire founders, Richard White and Chris Ellison. We have our annual check-in on the energy transition and take a question on whether M&A is really worth all the fuss.
But first, James, you did something pretty cool for paper pushers like us this week. You were up in Sydney and Dexus gave you a private tour of the Sydney office scene. James, you went to a bunch of the top buildings, the refit AMP Tower on Bridge Street, One Farris Street, the MLC Centre, One Bligh Street, even the new Atlassian development at Central Station. What did you learn?
Well, I guess I learnt that the office property market isn't created equal. Mm-hmm. You see a figure like, occupancy levels across the Sydney office market is about 87%. Mm-hmm. Well, in this sort of golden rectangle in Sydney, which goes from Martin Place down to Circular Quay, there's a lot of buildings in there that are running at 100% occupancy. It's quite impressive. And there's a lot of buildings, Anthony, that the investment bankers and the lawyers, they want to be in very particular spots in Sydney CBD. And, providing high-quality buildings in the right locations is still a pretty good recipe for success in the office market. But I guess the other thing I learned, Anthony, is there's a bit of pushback against the wastage in the office market. So when a new tenant comes into an office, often they do a new fit out and the CEO goes, I'd really love a couple of circular couches or a nice tiled area or whatever it is. And then 5 years later, they've outgrown that space or the space isn't right or something's happened to the business and they move on. Well, hardly any of that fit out ever gets reused. Most of it just gets junked. So it's a big waste of money, but also in the view of the Dexus team, it's a waste of carbon. All the carbon in all the materials and the floors and the ceilings and the walls, most of that all just gets thrown out. So they wonder if there's a better way to do this. You design offices with an eye to the future, sort of like hotels are designed. So a hotel is designed in a way that there's 20 years of refurbishments planned from the start. They'll change the beds in year 3, change the taps in year 5, do the curtains in year 10, whatever it is. But we don't think about that in offices. And so we end up with a lot of wasted money and carbon. So I thought that's really interesting, particularly when you've got all this going on with the future of work in the background. I don't think the future of the office is quite settled yet, Anthony.
Yeah, James, that golden rectangle you talk about, you can feel that it's the corridor of power when you're walking down there. You can see it, you can sense it, you can see the money and the power just walking along the street. And James, I fully get that end of it, but Dexus's biggest development's up the other end of town, right? The Atlassian project up near Central Station.
Yep.
So how do they sort of reconcile those two things?
Well, good question. Good question. I think they would say this Atlassian Tower is a bit of a one-off, mainly because it's going to have the word Atlassian on the top of it.
Yeah.
Atlassian's going to be the main tenant. There might be a couple of other tenants at the start, but eventually Atlassian will take the whole thing. So it's a bit of a unique building for a unique company in a unique spot. They want to be close to UTS, the technology university that's up that end of town.
Good uni.
Is that where you went, is it?
Mate, that's one of them.
There you go. So I think they see that as a bespoke project. And look, this thing's not going to be finished till 2026. My God, it is an engineering marvel even now. We went up into level 3. They were pouring concrete. But the first 6 floors of the building, Anthony, don't actually touch the ground. They hang off the 7th floor.
Wow.
And I'm sort of nodding, thinking, yeah, I get that. And I'm thinking in the background, geez, I don't know if I want to be on floor 4, but look, it's all going to work. It's going to look spectacular. And I think, it's a different building. This isn't a tower for, top tier law firms and American investment banks. This is made with a very specific client in mind. So hopefully it'll work. And Anthony, you scored a pretty cool interview yourself this week. Our Bank of America CEO, Brian Moynihan, he's sort of like the Matt Common of banking in the US and one of the top bankers in the world. Now, he was in town, believe it or not, for King Charles Tour. Because he chairs a sustainability institute that the Royals are involved with, but he made time for a chat with you. What's he like and what did you learn?
He's royalty, James. Wall Street royalty.
Wall Street royalty.
Not Buckingham Palace like his mate King Charles III, but, he was pretty smooth, sat back, answered questions. Didn't tell a heap of jokes, but was still, warm enough, quite softly spoken. He's not like the big, brash American investment banker. He's a bit more like, say, Westpac's Peter King. He's done a million of these interviews and was never going to come unstuck talking to me, James. But I was very keen to get his views on the US economy because it's something that we talk about every day. We talk about it every week probably on this podcast, James.
Yeah.
He's got his finger on the pulse more than anyone. He's in charge of the biggest consumer bank, the fourth biggest investment bank, the second biggest wealth manager. Like, his touch points are everywhere. And you know what, James? He reckons that we're almost at the end of all this sort of silly business that's been going on for 15 years now, the cheap or the free money era, the volatility, the low then high inflation with pretty sort of low growth. He reckons this whole sort of muck around era with rates bouncing around and everything is almost coming to an end. So by this year, he reckons that the Federal Reserve will have rates back at about 3 or 3.25%.
Yep.
Treasury yields will be back at about 4.5%.
Okay.
And they'll be relatively stable, and the whole world will be able to price its assets off that 4.5% risk-free rate, reasonably, return to what was normality, but just got disrupted in the past 15 years. So, it makes you wonder, James. Is this a 65-year-old bloke yearning for the good old days?
Yeah.
Is it a guy who's got a really risky business that's yearning for it to be less risky? Perhaps, but he was happy to talk about everything. Private credit, M&A, the US election, Australia. It was really good fun.
What was his tip for the US election, or was he not quite that brave?
Wasn't that brave, James? He got no more insight than you or me, he said.
Fair enough.
I believe that.
I bet he does. It's interesting though, Anthony. 4.5% as a sort of, long-term interest rate. There is a lot of stuff in this economy that is not built for 4.5% interest rates. There is a lot of venture capital. There's a lot of private equity that was all created in the cheap money, ultra-low interest rate phase. That's going to create some stress. He's right. There is a return to normality. There is actually supposed to be some stress in economies, but that would just be fascinating to watch, won't it?
Yeah, those high revenue, low earnings businesses won't be worth as much as they are today. But James, guess where he was going after Australia?
Ooh, China?
Samoa.
Yeah. Wow.
Yeah, it was part of this whole King Charles thing, but hard to look it up because I know it's floating around there in the sea somewhere, but at least it's on the way back to New York for him. It looked like it was probably about a third of the way back there.
Right. I don't know what the airline lounge is like in Samoa, but I hope he found a cool drink and somewhere to relax. Well, Anthony, what a week. I'm not quite sure we've seen anything like this in Australia before. For our first topic, let's unpack a huge week for corporate Australia, the ASX, investors, and really anyone with an interest in corporate governance. Two of our rockstar founder CEOs, billionaire rich listers Richard White and Chris Ellison, have been under the pump all week for separate and quite different corporate scandals. White, who is now the former CEO of WiseTech, stood down from the board and the CEO role after revelations about his private life and allegations of cultural problems within the WiseTech boardroom. While Ellison, who's the CEO of Perth miner and mining contractor Mineral Resources, must be hanging on by a thread after separate revelations about tax avoidance and related party transactions. Anthony, these are two of the most celebrated business founders in Australia. They both eventually listed their businesses on the ASX, they grew them substantially and have made themselves and their investors very rich. But Anthony, what's happened here brings into question Australian corporate governance practices and failings. It all makes you ask how scandals like this could happen and what a company is supposed to do when they do happen. All right, Anthony, let's start with Richard White. Can you give us a quick update on what's happened here?
Yeah, James, like you say, he's one of Australia's most successful software startup founders. He started with what's now the biggest software company on the ASX, WiseTech. He started it with Marie Isaacs, who's still an executive director 30 years ago. Now, he and WiseTech have been in our sight since it floated in 2016. You know, the company was worth $1 billion then. It's now $33 billion, was $45 billion last week. It's just shot him to fame and fortune, top 15 on the rich list. He's on the Tech Council board, which doesn't sound like much, James, but the other directors on that, you know, it's Scott Farquhar from Atlassian, Cliff Obrecht from Canva, Robin Denholm, the Tesla chair, Anthony Eisen from Afterpay. Like, it's real celebrity rock star crowd. Yeah, so he's a big deal. He's a big deal for WiseTech because White still owns 40% of it and was its CEO until late this week. He's a big deal for Australia's tech scene. He's a big deal for the ASX because he's one founder that's really come out supportive of public markets. And he's a big deal for all of us who aren't courageous or inventive enough to go out there and do it ourselves, James. Anyway, he's been through what he called a challenging time for him, his family and close friends and the company he built and loves. But he's been all over the front page for a few weeks, James. I mean, details of past relationships, including giving or allegedly promising to give multi-million-dollar houses to 3 women, one of which was playing out in court until it was settled on the quiet this week. It's pretty sordid stuff, James. You know, text messages between White's now wife, one of the ladies, that sort of stuff, the stuff that no one wants in public. Our paper's been all over it. So's the Herald, Sydney Morning Herald and The Age. You know, front page every day this week on the Herald. You know, Monday, they called him the LinkedIn bleacher, you know, saying White had approached numerous female entrepreneurs via text messages and social media with offers of professional support that could shift into sort of crude or suggestive language. Then it shifted onto the company when they revealed White had had a lengthy relationship with a WiseTech employee and then bought her a $7 million house when it ended.
Yep.
The whole thing, James, came to a head on Thursday when White stood down as WiseTech director and CEO. Now, he's going to take some leave and return in a new, full-time, long-term consulting role focused on product and business development, which are, you know, 2 things, to be fair to Richard White, 2 things that no one disputes he's been very good at at WiseTech. I mean, the statement late on Thursday, James, it was an absolute classic of the genre.
Anthony, though, can you just remind me, what's his new title?
Founder and founding CEO, James.
So he stood down as CEO and now he's going to move to the position of CEO. Is that right?
Hey, no one said any of this makes sense, James.
It is a diplomatic solution, isn't it? I mean, it's showing some accountability. It's taking him off the board, 2 good moves. But then it's recognising that Richard White is the engine room of this company and we want to keep him involved in some way, so we give him a snazzy new title. Yeah,
it's recognising he's the engine room. It's recognising he's the biggest shareholder.
Yeah,
it's recognising that he's been hugely important for 30 years and continues to be. It's damage control. It's trying to make the best of a really icky situation. But James, that's White and WiseTech. What's going on Mineral Resources and Chris Ellison?
Oh gosh, it's an equally torturous story. Now, Ellison might not be that well known. He's a giant in Perth. Perth is a town that sort of breeds these very big figures, and Ellison's one of those. He's a Kiwi.
Personality, I think they're called, James.
Personality. Thank you, Anthony. Good point. Now, Ellison is a Kiwi, came to Australia when he was pretty young and set up this business called Mineral Resources in 1995. Now, it started off in mining services, then over time it became a miner itself, and that's a good example of the sort of scrappy, nimble, flexible underdog that this company's become, always managing to find a way to sort of survive and eke out good profits by looking in places where the larger miners couldn't go or wouldn't go. And now the company went public in 2006. It's been a cracking investment over a long period of time for its investors. But what we learnt this week is it's alleged that for several years before and a few years after its float, Ellison and other executives allegedly used a British Virgin Islands domiciled company, that's a country famous for its tax shelters, to buy machinery and then on-sell that equipment to Mineral Resources at much higher prices. Now, Ellison self-reported this the profits made through this scheme to the ATO. He repaid some monies, and he admitted this week that it was, quote, a serious lapse of judgment. And the board of Mineral Resources now has an unnamed law firm investigating. But for me, Anthony, there are two issues here. Number one, did the scheme continue after MinRes listed? And so were the shareholder funds of a public company involved? Now, Mineral Resources says that's not the case. The second big issue here is, what did the board know and when? It's not clear that when the board knew about these problems, and they certainly didn't disclose them to shareholders. That was done by the Financial Review's great reporting by Neil Chenoweth. We also got fresh reports on Friday, Anthony, that Ellison was also involved in another sort of scheme where he bought heavily discounted equipment from Mineral Resources to use on his personal property in New Zealand. So, again, this is a story that just sort of keeps giving. Again, we've got a law firm investigating. Again, we've got a founder battening down the hatches. And again, we've got investors sort of stuck here. In part, they're thinking, I don't want to be investing in a company where things like this are happening, but I also want to be invested in Chris Ellison because he's been such a fabulous moneymaker over a long period of time. So it's really difficult. This is just such an ugly situation for everybody.
Yeah, James, these are two very separate cases happening at the same time, but united by the common thread, and that involves companies with these strong founders who have big stakes in their business, big control in the boardroom. Now, James, corporate governance is one of those things that it doesn't matter in the good times. It never really matters until it does, till times like this. And at WiseTech and MinRes right now, I mean, it's all that matters. So tell us, James, what's so difficult about having a founder and a big shareholder like a White or an Ellison if you're a director on one of these boards? Like, what's the catch?
Well, the catch is that you owe your job to the founder. Without Ellison and White, there's no Mineral Resources and WiseTech. If there's no Mineral Resources and WiseTech, there's no boards of those two companies. If there's no boards of those two companies, the directors don't have a gig. So every time you look down the board table at Chris Ellison or Richard White, you think, well, I'm only here because of that guy. And that just changes the atmosphere in the boardroom. It just creates a different vibe, I guess. Now, it's not necessarily good or bad, but it's just the way these businesses have to operate. How do you rein in the founder? How do you sort of ensure that their creativity and their genius flourishes, but they're always held accountable and they run the business not just for their interests, but also for the interests of minority shareholders? It's just a hugely difficult line to walk, and that's what we're seeing this week. You can have an independent chairman. Both of these companies have independent chairmen, but the power of the founder is so strong that you need to be really careful in how you deal with an instance like this. Anthony, I think if we saw allegations like this at a company that wasn't run by a founder, pick any name in the ASX, I think these CEOs would probably be gone. But what we have here is a different dynamic because the founder, as you say, A, owns so much of the stock, and B, is so fundamental to the success of the company. So it's a really sticky position for a board, isn't it?
Sure is, James.
And we've been arguing about this all week, I think, Anthony. You're sort of sympathetic to the founders. Tell us a little bit about why.
James, give me a strong founder-run business over a rudderless, identityless, friendless, non-founder-run company any day of the week.
Yeah, fair enough.
And I think most investors would agree. If you look at the past decade, and I'm stealing these numbers from a Sydney fund manager called Blackwattle, which created a founder index. Yeah. But if you look at the past decade on the ASX, their founder index is up 1,200%. That's got companies like WiseTech and Mineral Resources in it. While the ASX 300 has gained 57%. So 1,200% with the founders, 57% for the index, which includes the founder companies. And why is that, James? Like, what makes these founder companies often special? Well, founders care. They stick through the bad times. They're usually visionary by nature. They know where they're headed. They don't do dumb stuff. They don't just listen to investment bankers telling them to go and buy something and waste shareholders' money. They've been through the tough times. They know how to survive. They're not wasteful. Sometimes they can be a bit silly, and every year or two we see this funny story about the founder who sends around the email telling people to turn their computers off before they go home or something like that. But they're not wasteful. They don't waste shareholders' money, they don't normally raise equity, which is hugely beneficial when it comes to shareholder returns. And they don't normally get talked into sickening sort of deals by smart investment bankers to chase things that are sort of off strategy.
Yeah.
And White and Ellison, investors love them. And they love them for one reason, and that's because they're good at making money. Now, I'm not saying you need to overlook poor or questionable behavior. I mean, if you're listed and you're lucky enough to have survived those early days when you founded the business and you're funded by your family and friends, if you've broadened that out to have independent shareholders, you need to have the good corporate governance structures. But what I'm saying, James, is Australia would be so much poorer and the ASX would be so much poorer if it wasn't for the likes of these founders, who continue to be involved in their businesses. And we have heaps of them on the ASX. They're all a bit different. We've been lucky enough in this job to meet quite a few of them, James. Yeah. And you know what? We're going to get some more because Chemist Warehouse, if it comes to the ASX, we're going to get the Ganses and Murray of Rocky. And they're going to be some unique characters as well, I'm sure. So I reckon, James, let's not throw the baby out with the bathwater on this one this week. Like, founders, I think they're to be celebrated. I mean, they can and do work in listed market environments. They can and do create value for minority shareholders. I think the proof is very much in the pudding. But the thing is, James, there's plenty of benefits, but there's also risks.
Yeah, that's right.
What do companies need to do? What can they do to sort of transition from that, founder business to what we would consider a blue chip, well-rounded company from a corporate governance perspective?
I think it's about respect, Anthony. I mean, I agree with all the things you just said about founders, but once you go public, the game changes. Once you take other people's money, once you invite other owners alongside you, you have to respect them. They want to come along on the rocket ship with you, right? They're not trying to smother your genius. They're not trying to hide your light. But you do have to think, I'm now in charge of other people's money. This is a public company, and that means there are higher standards that need to be adhered to. So I think what you want here is a founder that recognizes that, a founder that says, yep, I've gone public. That gives me certain advantages, but it also gives me certain obligations, and I need to take those obligations extremely seriously. And you need a founder who says, having a strong board, having guardrails and accountability around me, it won't make this a worse company. It'll make it a better company. Like the perfect mix is where you get a strong founder who's really smart and they've got a strong board. That combination, that's unstoppable. And so that's what I think the founders and the boards need to work together. When corporate governance is working at its best and founders are working at its best, the result for investors is fantastic. So, I think that's the tension, and it's unquestionably a tension, but that's what you're trying to manage. So could WiseTech and the boards of WiseTech and Mineral Resources have done things differently? I'm sure they're thinking about that now. Would a conversation 10 years ago with either of these founders have made things turn out differently to the way they have? I think so. Hey, you're in the public spotlight now. You might be a private person who doesn't like the public spotlight, but you've chosen to list your company on the ASX. So put up with it. That's the deal. You can't be going off and treating your minority shareholders, your fellow owners, like they're less important than you. They are standing beside you. I think that's the important thing.
James, tell me this. So Richard White steps down, and then the equities research analyst from Citi that covers WiseTech comes out and says, the board and Richard White have come to a solution whereby governance and strategy have been effectively separated. Governance and strategy. Do you think that's truly possible to separate those two things at a company like WiseTech where you've got a nearly 40% shareholder?
Why would you want it to be possible, would be my question. Surely great strategy needs to have the guardrails of good governance. I mean, I can see where the Citi analyst is coming from. White's off the board. There's going to be a new CEO who's going to work alongside White in his quasi-CEO role. So I get the point, but I mean, in the White circumstance, the WiseTech board's just created a problem for another day.
Oh, yeah.
How are you going to have a CEO working alongside the founding CEO, both reporting to the board? I mean, let's say there's a difference of views between those two people. Who's the board going to side with? This is another corporate governance time bomb, and I think WiseTech probably knows that. They just needed to buy themselves some time this week. But I think there's a lot more to come on these stories, Anthony, so we'll see where it goes.
Okay, James, we've gone pretty heavy on the founders stuff there. So let's just do a quick one for our second topic. And it was the AFR's 8th annual energy summit this week. You attended it on Monday and Tuesday. Now, we all know that the energy transition is very complex, very expensive, very difficult. But I was taken by your optimism. For me, it was a noticeable change from last year. What was it based on?
Oh, I think the first little signs of progress, Anthony.
Yeah.
You're right, though. I've been to 8 of these summits, and I reckon the first 7, by the middle of the first morning, I was depressed because the problems just seemed to outweigh any progress. But what I was struck by on Monday and Tuesday was that there is like a blueprint to help us get this transition going. We need lots of renewables, we need transmission, we need storage, and we need a bit of firming power from gas in the main to make sure we've got a backup when the sun doesn't shine and the wind doesn't blow. In some ways, it's sort of as simple as that. Now, I'm grossly oversimplifying. Every part of that has got problems. It's hard to get a renewable power plant or a wind and solar project up at the moment. But our rooftop solar rollout is incredible. It's world leading. Yes, it's hard to do the transmission stuff, but we've got about 10% of the 5,000 kilometres of transmission wires up and going. Yes, it's really hard to do the storage. We still need to see if snowy hydro works. But hey, we've got some batteries going. We've got this pumped hydro projects around the world. And yeah, the gas peaking plant problem is starting to be solved or looks solvable too. So yeah, Anthony, I thought there was just enough progress to keep us optimistic. We're in the transition now. That's the good part, don't you think?
Yeah, James, I just wonder, you know how nothing unites like a common enemy?
Yes.
I just wonder whether this is the industry coming together to fight off nuclear, to stomp out that conversation before it really gets mainstream. These are all people, who are in the sector now. They're forging down that renewables path, they want to see that gas back up.
Yep.
If they come out now and say the transition's cactus and we can't do it, well, we as all the voters are going to go, all right, well, this crew's no good. We need to find someone else that works. And in the background, there's this magical thing maybe called nuclear. Build a plant, it lasts for 100 years, no outages, pumps power morning and night, rain, hail or shine. Completely ignoring the fact we have a tiny, tiny nuclear industry, would require legislative change, cost tens of $billions, decades to build, et cetera, et cetera. I just kind of wonder whether that has helped sort of
galvanise people.
Galvanise people.
Yeah.
That's a lovely way to put it.
Perhaps. Although I think there's a fair bit of openness about nuclear. And again, it comes back to the perspective. Like, we sort of tend to want everything to happen immediately, right?
Yeah, we sure do.
This transition is going to be happening over the next 25 years. So it could be that in 25 years' time, that would be the good time for nuclear to sort of kick in. So I actually think people are saying, hey, this is what we've got to get going on right now. Nuclear is a story that would kick in 2 decades' time. So keep talking about it. That's all good. But we got to have something going now, because the nuclear rescue plan, even if we press the button on it today, you're not getting any reactors built for 20, 25 years. So, yeah, I take your point. But it is an interesting point about this transition, though. There's going to be waves of this stuff, like solar panels, wind turbines. They're going to last for 25 years, and then guess what we're going to be doing? Replacing them all. Yeah. So, this is going to be a rolling fight that's going to go on and for the rest of our lives, and it's going to be messy all the time. We're just going to have to live with it.
James, I was struck by the way that everyone seems to be fixated with gas now and the role that gas needs to play. It seems like gas isn't the horror story that it once was. I mean, did that sort of come through at the conference?
Absolutely. Unanimous view that gas peaking plants are the sort of short-term flexible fit to firm up renewable power. Only one problem, Anthony. We don't have enough gas. So much of our gas is exported to these big LNG contracts, which are signed and sealed, so not much we can do there. So the question is, can we find more gas? Can we find more gas onshore in Victoria? Well, sort of effectively banned there.
Yep.
Can we find it in New South Wales? No one wants to drill for gas in New South Wales. Lock the gate movement is very strong. Queensland's got a bit of coal seam gas, but we need more. So this crazy idea of a country like Australia, which has heaps of gas, may have to import gas in the coming years for the east coast of Australia. That's a live possibility, unless there's some change in the way we approach gas, which is difficult politically and environmentally. So, yeah, it does seem to be the unanimous solution, but comes with more problems, of course. And Anthony, I found it interesting, the investor perspective on all this. I know you speak to these guys a lot. I did a panel with some big investors. Yeah, they're frustrated with planning approval delays and, community social license issues around stuff like transmission, but they still want to put big amounts of capital to work in Australia because the opportunities here are so big.
Yeah, James, what we find, there's a lot of people in a lot of jobs who have a lot of money to put to work. So the capital's always in and around it. They're always interested. Their jobs depend on it. In infrastructure, particularly if you look at like regulated power infrastructure, poles and wires, gas distribution networks, it's all about contracts and how contracts are structured. Who takes the risk? Does the risk sit with the person that owns the infrastructure? Does it sit with the person that's buying it or where the actual power comes from? The more, obviously, the less risk, the less return. But as a general rule, you're right. There's plenty of money around. Ask the big super funds. They will all say they're interested in decarbonisation, investing in the transition, all that sort of stuff. But they have to say it, James. I'm not convinced that a lot of people are lining up to write a lot of checks. What did your investors say on the stage, though?
Oh, yeah, they said they are, but you're right. Let's see the money hit the ground. But I think there is still a lot of capital for this. It needs a lot of capital. But you're right. It is getting the checks out of people's wallets that's going to make the difference here, and there are some hurdles to that, including planning and regulatory approvals and that sort of thing. So, I guess it's a watch and see. But look, don't cruel my optimism too much, please, Anthony. All right, we'll come back after the break. We've got a really interesting question for our M&A expert. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Friday, the newsletter pulls together the best Chanticleer columns from the week and the best bits of this podcast and delivers them straight to your inbox. All right, Anthony, we're scaling the mountain again next week. We've got the AFR Super and Wealth Summit in Sydney, where we're both hosting some really interesting panels. I've got Wayne Swan, the chairman of C-Bus, the big super fund linked to this CMFEU, so that'll be great fun.
Absolutely. James, we pull out big stats about super all the time, and we've got another one this week I just wanted to mention briefly. Guess how much money super funds put into Australian shares in the June quarter?
Hit me.
3 months to June 30.
Hit me.
$12.8 billion.
Wow.
$12.8 billion of new money in one quarter. That's huge. That's the equivalent of $50 billion a year. There's so much. Another way to look at it, James, you know what you could buy for $12.8 billion? You could buy Qantas, you could buy ASX Limited, or you could buy Myer, Domino's and GYG together and still have a few bill left over.
Wow. Fantastic. Yeah, well, that's why the Super Summit's going to be important this week. On Wednesday, the big bit of economic data that us and the RBA have been waiting for, September quarter inflation. I guess, Anthony, we'll know if how much further that rate cut away is after this week.
Yeah, that's right. And it comes 1 week before an RBA board meeting too, James. So it's very, very timely.
And then on Friday, the Macquarie Group will have its half-year result, kicking off bank reporting season. And while that's happening, we're hosting our Chook Brunch event in Melbourne, which is going to be great.
Sure will.
And I should say, Anthony, there's another notable event next Tuesday, and that's the launch of Joe Aston's new book on Qantas.
Oh, yeah.
Great friend of the podcast, and I can reveal that he will be appearing with us next week to talk about his tome. So stay tuned for that. It's going to be great fun. All right, we love questions here at the podcast, and this week our question is from Stephen from Sydney. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it through to us. So Stephen asks,
Hello, it's Stephen from Sydney. Mergers and acquisitions are a theme of this podcast. I understand that M&As make a lot of people a lot of money, but do they really benefit shareholders in the long term? I recall reading in The Economist magazine decades ago that, quote, 49% of all mergers and acquisitions add shareholder value. Have the odds improved in recent decades? What are your thoughts? Thank you.
Thanks, Steve. Great question. And we're lucky to have an M&A expert resident here in the Chanticleer Chook pen. Anthony, is Steve's scepticism warranted?
I think Steve's on the money. He's right. A lot of people make a lot of money out of pumping up M&A, James, and that's why there's always an investment banker or lawyer in the game willing to tell us that M&A conditions are going to get better, the pipeline's better, all that sort of stuff. They're just trying to drive activity. Now, James, all companies, listed companies, if we just talk about listed companies, they're under pressure to grow earnings. Management teams under huge pressure. If they can grow earnings, the share price goes up. It's that simple. They get rich. The investors get rich. Life's much, much easier as long as the governance structure is also right.
Yes.
So when you either grow, James, I mean, in an ideal world, you grow via inorganic means, right? So you make your existing business better, or you do something sort of adjacent. You launch a new product, do something adjacent to what you already do. But in Australia, it's really hard to find that inorganic growth. Our industries are quite concentrated already. And unless it's something new out there in the marketplace, for example, streaming services, for example, they didn't exist 10 years ago. Now they exist. And you're someone like a Foxtel, you can launch KO to get into streaming. So unless you can find like a new sort of market that's opening, it's really hard to get that inorganic growth. So often management teams have to chase M&A to try and find their growth. And M&A is much more risky. I mean, you can do due diligence on a company for 6 minutes, 6 weeks, or 6 years, but until you own it, you don't really know what you're getting, what you're buying. And that's why so many deals seem to come unstuck.
Yeah. I reckon Steve's on the money. The odds haven't improved. Half of all deals work, half of them don't. And it's very difficult when that deal is announced to tell which side of the coin you're going to end up on. So be skeptical about all M&A because it deserves it. All right, Anthony, look forward to seeing you in Sydney next week and can't wait to have Joe Aston on the podcast.
Yeah, James, have a good weekend.
See you all next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.